All right, so Haas writes in with a question about Wellesley, and total stock index. So let's read this. Good question. Been meaning to get to for a while, and you can hear my dog in the background. The dog channel. I don't like dogs. I was talking to a guy today, a client, freaking just a great guy from Louisiana. I tell you, man, Louisiana people are my kind of people, except for the fact that Louisiana is cold, and I'm not cold, it's rainy, and they like the Saints. Other than that, Louisiana people are A-okay by me. This guy's fantastic. Anyway, I said, sorry about my dogs back there. He goes, dude, come to expect it. I said, no, that's cool, man. This is fantastic. I tell you, Louisianans are righteous people. That's all there's to it. It's just, it's fun. I like it. I said, man, I will never, ever, ever live in Louisiana, ever. Look, shh, don't tell anybody this. If it ever says that I'm retiring to Louisiana, I have been kidnapped by Fauci, all right? If I ever do a video that says I'm retiring to Louisiana, I have been kidnapped by Fauci. Just keep that in mind. All right. I would say call the feds, but don't call the feds. Call, just say a prayer. All right, so Haas says, I'm following your advice about the Vanguard Wellesley funds for retirement and the 3 year to 4 years of cash. I understand when you said those funds generally lose less than holding a total stock fund in a down market. But I'm curious, if I have 400,000 retire on, would it be wrong to put 100,000 in cash, 200,000 those two funds, and 100,000 in a total stock market, so that the stock fund would still expose me to outsized gains? I'm not sure they're outsized gains. All in all, in the down market, I would switch to cash anyway. What I miss about the risk? Let's take a look. That's actually a real good question, Haas. Let's double check. Portfolio visualizer. We're just going to go to 2007, and we're going to go to 2009. I guess you know what let's see. Wellington would be. Well, let's just go to 2000. That's what we'll do. 2000. There we go. To now, we're going to have 400,000 schmackers, and we're going to put 100,000 into each. We won't rebalance. We will reinvest. We'll go to, I think it was, got to do, was it # cash? Is that what it was? 100,000 bucks? Oh, you got to do 25%. All right, # cash, 25%. I think that worked. VWELX, 25. VWINX, 25. Then VTSMX, 25. There we go. Let's see if that works. And then we're not going to rebalance. You don't want to, you literally don't want to rebalance in a situation like this. Didn't know cash. All right, so what do we do for cash? Cash right there. Okay, cash X. Okay, gotcha. All right, there we go. All right, so we got a quarter in each. All right, you don't want to rebalance. The reason you don't want to rebalance is because the whole point about the barbell is to take the money out of the stocks, and the stocks do well, and the cash and the stocks do poorly. It's just that simple. All right, so here we go. This is without taking any distribution. So we put 400,000 bucks in there. In 2001, it's worth $1.5 million today. That's nuts. The max drawdown was 26%. So from October 2007 is at 638 till March 9th of 2009, it went to 470. So 638 minus 470. 638 minus 470 divided by 638, 26%. Right on, 26.3. Perfect. All right, then right there fell from January to April. It fell from 1.3 to 1.17. So that's not that big of a. It's something, but not huge. It's not a bad move, man. I like it. So let's now say we're going to take 5% a year, and we're going to withdraw a fixed amount. Now this is kind of weird. Inflation adjusted contribution amount for inflation. And I'm starting to think this doesn't do it. Oh, we were rebalancing. I don't want to rebalance. So hold on a sec. We don't want to rebalance. So hold on. We're not going to withdraw, I think. All right, so we're not rebalancing. Okay, so that was rebalancing. I said that seemed not rebalancing. Did I hit apply, analyze? There we go. There we go. Not rebalancing. Oh, the max drawdown went down a little bit. That's interesting. That is interesting. Not rebalancing. Max drawdown went down from 26 to 25. That's interesting. And now not rebalancing. We're at 1.66 million. Yeah, I just okay, that's fine. So let's not rebalance. We're gonna take withdraw a fixed amount. We're gonna withdraw is that 20,000 a year, and we're gonna adjust it for inflation. So this is what's interesting, because someone was saying that the withdrawal function wasn't working right. Adjusted contribution withdrawal amount for inflation, and we'll see. Yeah, it's fine. Yeah, 20,000. Okay, let's hit analyze. What's this? Drawdown. All right, so drawdown period based on monthly returns, November to February. Drawdown period based on monthly returns. I don't get the difference there. I don't get the difference. What's the two differences? This must be pulling the money out. I don't know. All right, so let's take a look. We had $400,000 starting in 2001, and we're sitting at 362 today. I wish it'd give us the total income we took. It says, let's look at drawdowns. Yeah, right there, 25. Okay. Huh. Metrics, exposures, monthly assets. Let's look at last total return. So let's look at, I don't think it's going to do for April or March of last year. Yeah, right there. Yeah, it's 12%, 13%. It's not that bad, man. It's actually a pretty good portfolio. It's actually a pretty good portfolio. I just wish it'd give, let's see, assets. So here's the cash, where everything else is getting crunched. Does it give us exposures? Large cap value, large cap growth, I like that. Mid-cap, we don't have anything small. We don't have anything that's small. Why are they not? I mean, the VTSMX has a little bit small, not much, but I don't know if I dig that. Short-term treasuries, that's our cash, I guess. Yeah, it's got to be cash. Yeah, I don't know if I agree with that. VTSMX has some small. I'm not sure I agree with that. But anyway, okay, let's allocation drift. Don't really care about that. Assets, we talked about that. Why don't they have I wish they'd give you exposures. We talked about that. Metrics. So we averaged a geometric 6.84%. The compound annual growth rate. Standard deviation there, I saw someplace. What was this? This is such a, I mean, this tool is fantastic. I saw standard deviation. I know I did. Downside deviation, monthly. I'm not exactly sure what that means. Downside deviation monthly. Did not see a standard deviation. Upside down. Oh, look at the downside capture ratio. Upside capture ratio is crazy. Safe withdrawal rate 6.4%. Oh man, look at, I didn't know you could do all this on this. This is freaking nuts, man. Safe withdrawal rate. So what's it? We gotta find out what all these numbers, what all this stuff means. I don't know what it means. Safe withdrawal rate versus perpetual withdrawal rate. What the hell is excess kurtosis? Jeez, man. Kurtosis. We're on keto. What is it? Keto. You got ketosis, whatever the keto thing is. Ketosis. 58%, or was that 68% were positive? I guess that's of the months. I'm not sure. Downside capture, it got 38% of the down and 50% of the up. That's exactly what you want. That doesn't make sense. Only 38% of the capture? Yeah, no. Maybe. I'm not sure about the historical value at risk. I'm not sure what all these numbers mean. I get tracking of the Calmer ratio. I used to, all this stuff is, some of the stuff I used to know, a lot of it I don't know, and frankly, I don't care. But volatility monthly, 2.1%. So would you times that by 12 to get 24% standard deviation? I don't think so. I don't get the volatility annualized. There you go. Is that our standard deviation? Yeah, it seems pretty low to me. I'm not sure. Maybe. So would you, if it's 7.39, if that's a standard deviation, Would you times that by 3 to get roughly 22% for 99.8%? I don't know. That's interesting. You can look at the, I'm sure there's a FAQ right there. I just don't get the withdrawal stuff. Inflation adjusted. And then if we did fixed percentage, and we did 5%, right, and we do inflation adjusted. Will that change anything? Yeah, it still looks like the same. Compounded, oh, there's compounded annual growth rate. 1 point, oh, because we're taking money out. I gotcha, okay. And now we're at 500. So 5% on 400,000, we're drawing annually and adjusting for inflation. No, you're not adjusting it. You're just taking 5. Yeah, see, you don't want to use this. That's what I'm saying. It's just a 5%. I don't like that at all because you're just using 5% on whether the market's doing. Market goes up 5%, market goes down 5%. If you're going to do that, do this like 7%, man. I still think that's the way to do it. I mean, look at that, 7%. Compound annual growth rate, nothing, but you start with 400,000 and 21 years, you're still sitting at 357. Now you're taking 7% a year out, so 7% is 28,000. That's I don't know what that's 25,000, I guess. And if you're doing a 5, so let's see, let's do a, bear with me just a second. 20, yeah, so we're gonna do 20,000 and see how much we're getting out now. I don't know what we're getting out actually, because I don't know the inflation numbers. Because I'm gonna tell you, that's pretty interesting. I'm kind of digging that, Haas. That's not a bad portfolio. I just, I tell you, man. Think about it. So if we're taking, if you're taking 5% a year, that's 5 years of cash. Wellesley, Wellington, and total stock index. What's the total portfolio mix here? It's going to be, well, we already said that. It's exposures. It's 38% short term, 10% corporate bonds, 44, 45, 46. It's about a 50, 40 with some cash. That's not a bad portfolio. No, pretty good portfolio, man. I like it. That's a good question, Hoss. Hope this helps, man. We'll see. I love your thoughts. We'll see you.